Hi, it's the analyst from Think Like an Analyst, and in today's video, we're going to take a look at a handful of gig economy stocks with a special focus on the food delivery and transportation space, where companies have struggled to break even. These are what I call story stocks that trade not on their actual or past performance, but on the value creation potential that is embedded in their stories. Now, stories are an important part of any investment case, but it's always important that you translate these stories into actual numbers so that you can value these stories without just pulling numbers out of thin air. And the best way to do this is with a model. Let me show you what I mean. So let's start with the stories. Now obviously each company has their own unique story, but I think they all follow a similar plot line. 1. These are all disruptive companies that have upended the way certain businesses have traditionally been conducted. 2. These companies are essentially technology platforms that rely on powerful network effects and a huge supply of gig workers. 3. They are all addressing very large potential markets. 4. These companies are operating in very competitive markets, and they are all in a fight for brand recognition and market share. This has put downward pressure on pricing and has contributed to the fact that none of them are yet profitable. And 5, despite the fact that these companies are not yet profitable, they have been very effective at selling the idea to the markets that there is in fact a path to profitability, even though they haven't been explicit about what that path is. And as a result, the markets have been willing to fund their losses to date. So the key uncertainty in the storyline is this elusive path to profitability. And while we might not know what that path looks like, we can certainly put some numbers to it and try to model it out. To do this, we've essentially reverse engineered each company's share price by mapping it to a set of 3 forecast variables over a 10-year forecast period in our models. That is revenue growth, after-tax operating margins, and capital turns. So to begin with, we know that a key element in the profitability story is scale. So we've built into our model very aggressive revenue forecasts that assume that each company achieves the scale required to reach profitability. As a starting point, we've taken consensus revenue estimates for the next 2 years and then stabilized revenue growth at a very aggressive 25% for the rest of our 10-year forecast period. Secondly, we've moved up slightly our capital turns forecasts on the assumption that increased scale will allow each company to utilize its capital more efficiently, and this will help boost returns and cash flows. And finally, we've used our operating margin forecasts as the final lever in our model. Don't forget that these companies are all still operating at a loss, so we've had to move margins from negative to positive territory. And then we've moved up the margin forecast until our model generates a fair value target equal to the current share price. Of course, there are endless combinations of growth, margins, and capital turns that will get us to the same result. For example, we could taper back our aggressive growth forecasts, but then we'd have to bump up either our NOPAT margin forecasts or our capital turns forecasts to get back to the same place. So the point of the exercise is not to pretend like we can predict what the path to profitability will look like. Rather, we've simply mapped out a set of forecast scenarios that approximate what the market expects in terms of future financial performance for each company. As I said, each company has their own unique story. In addition, each company has their own unique financial profile, and this has an impact on our forecasts and the kind of financial performance each company will have to deliver to justify their current share price. For example, because these companies are all essentially technology platforms, you would expect them to be asset light and therefore to be relatively efficient users of their capital. This is typically reflected in higher than average capital turns. And in fact, if you look at both Lyft and DoorDash, this is in fact the case. Uber and Grub, on the other hand, have much lower capital turns, and this has to do with the fact that both of these companies are carrying on their balance sheets asset related to past M&A activity. Uber, for example, is carrying $10.5 billion in illiquid assets related to the sale of former subsidiaries. Grub, on the other hand, is carrying almost $8 billion in goodwill and other intangibles related to its recent acquisition of Grubhub. This means that both Uber and Grub are going to have to generate economic returns on these assets in addition to generating returns on their core operating assets if they are going to create any value. So from a forecasting standpoint, it means that both Uber and Grub will have to generate higher margins than Lyft and DoorDash in order to justify their current share prices. Uber, for example, will have to generate NOPAT margins of 8% to justify its current share price, and Grub will have to generate margins of 11.7%, while Lyft and DoorDash will have to generate margins of 6.2% and 5.1% respectively. And finally, it's worth evaluating whether these differences are reflected in the valuation comps. From the same table above, we can see that DoorDash, for example, has the lowest multiple on a price-to-sales basis, but it also has the lowest margin target, suggesting that it will be easier for DoorDash to grow into its current share price. Grub, on the other hand, has the highest price-to-sales multiple and also has the highest margin requirement, suggesting that it will be harder for Grub to grow into its current share price. So to wrap up, it's hard to make any firm conclusions from this analysis, except to say that all four companies have their work cut out for them over the next few years. They all claim to have a path to profitability, and their respective share prices reflect an expectation that they will deliver on this promise. Our models, which I've linked to below, have made explicit what this path to profitability might look like. What do you think?